Hey guys, we're live with George Coyle again. So we're on every Wednesday, so definitely check this out. Feel free to ask questions. Um, we're here for you guys. We have a lot of information out here. George has a ton of information on traders, and all the greats that you guys want to hear about and learn about. Please write in, ask questions. But today we're talking about George Soros to Stanley Druckenmiller. So going through these people. So many people, I was telling George earlier, there's a lot of guys who know who Druckenmiller is because they watch TV or they're traders and they're learning about it, but they don't really know where he comes from or his school of thought. And then Soros also is in there too, where a lot of people kind of know this guy and these crazy trades that have happened over the years, or wild conspiracy theories about the guy or whatever. And that's about it. So let's start with Soros, George. So if we go through Soros, understanding his methodology, his books. Yeah, I even read one book. I can't remember the name of the book I read by him. I read all of his books. One of them, though, he definitely has a God complex. So what did you think about George Soros? What do you think of his trading style? Anything really stick out for you in any of his books that you were like, this guy's very smart or this guy's not?
Yeah, I mean, I wrote a paper about him. I just sent the link. And once again, sorry everyone, I didn't sign up so I can comment to the group. I got to do that. Stop procrastinating. But
No worries.
I guess regarding his books, it's kind of funny because one of the guys who knew him best they said, "Did you read The Alchemy of Finance?" And he said, "Yeah." And somebody said, "Can you summarize it?" And he said, "Probably not," and started laughing. I thought it was like a really hard to follow book. And I don't think I'm alone. I think like he's got his overarching philosophies on sort of reflexivity, that situations influence the participants influence the situation. So it's sort of a dynamic interplay between what's happening and perceptions, and then boom bust cycles. And from the research I've done, he basically uses, well, I don't think he does much trading anymore, but anyway, I think he used those sort of overarching philosophies and was looking for them. But his trading style was really more like a trend follower. And he would, they said he'd get an idea and he'd test it in the market. And he would use, I wrote something about this too. I'll find it, post or send it to you. But basically, a lot of the things that he said were very much like Livermore comments. It was kind of like scary. It's like they were saying things that were almost verbatim the same. So he would take a small position, which they would call a toe hold position, or that's what he called it. And then if it didn't work, he wouldn't add to it. And if it did, he would just keep adding to it. And one of his early lieutenants, for lack of a better term, said that his philosophy was like, if the position's working, you should just let it get as big as it can. Like if it becomes your whole portfolio or 200% of your portfolio, that's fine. That said, like he was a loss cutter, and the title of the paper, or at least what I titled it, was "World's Greatest Loss Taker," and that came from a Stan Druckenmiller quote where he said, "Soros is the greatest loss taker I've ever seen." And that seems to be the thing that sort of differentiates traders from, I guess, investors or whatever, is they have a preset method, whether it's like a hard stop or a emotional stop where they get out. But another interesting thing I found about him was he would talk about his backache, this Soros, his backaches and how like his back would hurt. And he said, well, it's not like bonds are upper right and stocks are lower left. But his son said that it was like a psychosomatic manifestation of his angst about his portfolio. And if it wasn't going well, he would just get out and then the backache would go away. So one of the more interesting things about it is like a lot of the people in the business, they say, you got to remove emotions. You got to get rid of emotions. Whereas for him, I think his emotions were kind of his guiding light in knowing when to stay with something and when to get out of it. And he used sort of his instinct and his emotions as allies. And when something was working, he would just get huge, massive positions. I think we talked about last week, if you're going to make giant returns, you got to be willing to take big leverage positions. But when it wasn't working, he would just, via backaches or other mechanisms, he would get out. So his approach was definitely interesting. I suppose the caveat to all of that is he was doing this, very early in the game. So there weren't many competitors, and there was probably a lot of low-hanging fruit. I think that the returns at Soros, cognizant he's been kind of out of the main position for a long time, are nowhere near the sort of 30-40% CAGRs that he used to do in the, I guess, maybe 60s, 70s, stuff like that. So that's, I guess, a brief overview. The paper that I wrote really does a good job, in my opinion, of summarizing all the different books. And there's other tidbits you can pick up from reading them, but I tried to sort of triangulate, as is my ilk, information from multiple sources, including interviews about him and things he's said, to find out where the truth of how he does stuff lies. So, yeah.
No, I completely agree with that book. It's a great book. Like, there was some stuff in there that I can peel some pieces off of, and I still use to this day, or random quotes that are interesting, but it doesn't have a flow to it. It's not something you could write on the back of a napkin and understand. And honestly, if you look through history, and he would call himself a philosopher, you look through history at most philosophers, most of their theories you could write on the back of a napkin, and understand. I mean, think of Kant, and I think therefore I am. Like, it's very simple things, but the central piece of Soros, I couldn't summarize it in the book and say, hey, this was the central theme or the central idea. And I don't think he can. So I think that's a good point. I never heard that story that he couldn't summarize it, because that's the truth.
Yeah, it's in there. I mean, and if you go through with like a fine-tooth comb of all the stuff, his biographies, there's one that was authorized. He wrote one himself recently, which was sort of more broad than just markets. I mean, from my understanding, he doesn't want to be remembered as a markets guy. He wants to be remembered as a guy who opened societies. But there was an unofficial biography, and then there's interviews with people that work close to him. And you just find little things like he says, oh, you can summarize reflexivity as imperfect understanding. And then later he uses that specific phrase, imperfect understanding, to describe how he trades. So if you kind of gather it all up, you're like, oh, wait, he said this, and this is what he said here too. And it gives you a clearer sense of how he did things. But one of the things I guess I do at the end of these papers I write is put together a summary, and I'm just trying to scroll to the bottom here. But it basically goes through what he did in aggregator, how to sort of do your best to trade like he did. This is a long one. Sorry. But yeah, so it's, here are kind of the things. Accept human fallibility as a universal truth and come to embrace taking a loss when necessary as the only logical action given the universal truth. Develop a thesis about the future. Doesn't have to be amazing. These guys weren't forming brain trusts. They said his big thing was invest first, investigate later. So it's like, take a position before the thing moves, and then do your research. And if it moves in your direction and the research is there, then take a huge position. So yeah, take a toe hold position to see if it works. If it does, add to it and ride the trend. If it doesn't, get out. If conviction's high, go for the jugular, which is bet big, but still manage risk. But one of the interviews he did around the time of the British pound trade, he said, like, even if it had gone wrong, they would have only lost 2 or 3% of the portfolio. And they had I think it was a 200% position. So clearly he had a pretty tight stop on that, right? However it was structured. Anyway, so go for the jugular, reevaluate all aspects of the thesis, real outcomes, and price action. So if anything is not happening the way you think it is, reevaluate it. The early guys who worked for him said, like, it was exhausting because he just was constantly like, why is the stock not doing it today? If anything makes you think twice, emotions, price action, events not happening as expected, get out. You can always get back in. And number 8 was repeat. And from there, it's hope you get some good luck. So that was kind of my summary from spending however many months or years I did studying and writing this thing. And it's a good approach, but it is interesting. I guess to me, concentrated positions, whether with leverage or not, lead to bigger results, but also big downs. And I think the emotional thing was just one of the more interesting things to me, because again, so many people say, don't use your emotions, find your way around them. People think systems will get you around emotions, but they really won't. It just rolls it up a level. So incorporating them, to me, in my opinion, was a big part of what made him successful, for whatever that's worth.
No, and you know, people always use that you know, it's you got to be a pig. You know, from Druckenmiller, understanding from Soros, you know, sometimes you got to be a pig. And Soros understanding that you know, sometimes I agree with this, and a lot of people don't, which is when you have these positions and they are running and you are making a ridiculous amount of money in that position, and it's compounding to the point where it's the size of your portfolio. I fully believe with leaving it as well. You know, Jerry Parker and I had a long discussion about this, talking about the fact that people look at it and they start to go, okay, now my 1% stop has become a 2%, it's become a 5%. And they look at it like they're losing so much more in their entire portfolio. And it's true, your volatility of your portfolio is going to go up. But if you're a person who doesn't really care about that volatility in your portfolio, you can just understand that, hey, like you know, I'm making this much on this trade. That's really got to be the goal as a trader. Yes, like if you're trying to manage money for clients and you're doing it a certain way, and you have a, you know, your prospectus basically says that you're trying to have this low Sharpe ratio and so on, sure, do whatever you got to do. But if our goal is just simply to make money, I think that's the way to do it. Let those positions run, because I always say, like, something a couple of years ago, I remember Bitcoin became a huge part of my portfolio. I would say it basically every down day the portfolio was down, every up day the portfolio was up. Like, that's how big the position got. And at some point I had to just go, hey, you know, this thing, it's running, it's making a return. Yes, the volatility is high. Yes, this is getting frustrating. It's hard to deal with at times, but is the goal to make money, or is the goal to have a very smooth return so Jason's happy? And the goal has to be to make money. So get out of the way, let it run.
Yeah, I guess it all goes back to goals. Like we
Mm.
keep saying over and over. I think one of the things you can do is you can kind of infer from people's drawdowns what they do and how big they let positions get, because most drawdowns are measured against monthly returns, right? So you're not going
Mm.
to see like the dailies or the intraday necessarily. But if somebody has really tight drawdowns, like I guess if you let positions run, something goes up 100% from where you bought it, say it's your whole portfolio, and then it's down 50, you're going to have a big drawdown, right?
Mhm.
Um, but if guys don't get those kind of drawdowns, then they must be taking off positions or lightening them up or rolling their stops up to prevent it. So I guess the point I'm trying to make is if you look at the returns and the drawdowns of different managers, you can get a sense of how they feel about that. But I guess it's another thing where there's like no right answer, right? I mean, which is the best solution? I don't know. It depends on you. Like you take a Louis Bacon, and supposedly from the research I've done, he was in and out all the time, and he more or less never had big drawdowns. So he must not have been leveraged 10 to 1 or anything like it, right? Or at least if he was, it was very brief. And then I guess you look at other people that had bigger drawdowns. Nobody jumps to mind at the moment, but they clearly like would take those positions and hold them and let them just run and run and run. I guess Sakota, right? So Ed Sakota says in one of his things that his system accounted for and had 50% drawdowns routinely. And he made huge returns, but he was okay with 50% drawdowns. So all that stuff, it's back to goals. Like, should you reduce position sizes if they go up very quickly and your stop is far? It's, I guess, Jerry Parker has an opinion on it, and Tom Basso has a separate opinion. And in the end, like, I guess in hindsight, you can know which one is quote unquote right or wrong, depending on who made more money and had less drawdowns, whichever metrics you target. But it's more of a philosophy, I think, is what I've learned studying it. And which one you want to do kind of depends on you. Because to your point, like if you can't take the ride or you want the smooth, but you want the big returns, how do you balance those two and find the right approach? Without the time machine, we just don't know. You just, yeah. That said, I guess the one final thing I'll say is the highest returns and also the biggest lows seem to come to the guys who take monster positions and just sit with them. So,
Yeah, it's tough. It's once again, people always ask, and Jerry, I watch Jerry and Tom, and they'll argue this point back and forth. And to me, I don't argue it. I just say everybody's different. You know, it's not only who you're managing for, but it's also what type of drawdown can you handle? I've met great traders who can barely handle any type of a drawdown, and they do very well for themselves. I've met people who trade like me, and even pyramid into positions, which I do not do or even advocate for doing, and they make money. So I mean, it's just how do you fit in as a trader? Like that's the thing you really have to figure out. Do you fit into that crowd that's being a pig per se? I mean, I think for me, I started a very small position. I never have like Soros would talk about and Druckenmiller too, having these convictions in these trades at times and being like, oh, I knew this was going to happen. I'm going to go huge into this trade. I've never had that a day in my life. I only think that the one thing I do know is that trends exist and they persist. So if trends exist and they persist, I will let something become a larger size of my portfolio because it's trending well, it's making money, and that's the only time I ever do that. But thinking about the people that do that, what do you? Because we've talked about.
You said that. Did you mean your philosophy or the guys that concentrate and
that go straight in huge, that like start out huge into a position like a Soros or a Druckenmiller? Like, have you seen that that full conviction trading idea? Have you seen that across many traders, like a Soros or a Druckenmiller, or is that kind of like a thing that is a little bit more rare than other people?
I don't know how to answer for sure. I mean, I guess what I could say is like Livermore and Arthur Cutten and Soros and Druckenmiller, from what they say, which may not be exactly what they do. I don't see their statements to the extent they're still alive. I guess the thing about those guys is they would take initial positions, and if it didn't work, they wouldn't add to it. And that really, goes back to Livermore. He started off where he'd take big positions, and gradually he said, I'm going to use. He called them probes, which I think we've talked about before, but he'd start with a fifth and then add another fifth and another fifth and then two fifths to get to a whole position. And whether that was 100% of his portfolio or 1,000% of his capital, it varied. But I guess that's what I see with the Soros, Druckenmiller, Livermore, Cutten, guys of that kind of ilk. They tend to start small and then go. And Druckenmiller says he does a third, a third, a third. I just described Livermore's approach. Comparatively, I mean, there are guys that take huge positions, like the Big Short movie, Michael Burry and Paulson. Depending on how they structure it, they're usually sort of asymmetric in the sense of it's like buying a call or a put, right? They're not taking big positions. But I guess if I had to say anything, I would say this. It's rare for people to take big concentrated positions nowadays. Diversification is sort of the thing that most people champion. And it's interesting because we talked last week about all your eggs in one basket, and that goes back to Andrew Carnegie. And Stan Druckenmiller is a big proponent of that. He says diversification is a bad idea if you want, good returns. But even then, if you look at his portfolio, I mean, he has at least a 13F that's disclosed, doesn't have his futures, but he's got 40 positions, cognizant that the majority of his portfolio is in 6 or 8 positions. He's still not like just all in on 2 or 3. I don't think anything usually gets much more than 20% of his portfolio, at least in stocks. So yeah, there's not a lot of guys that go all in. I mean, he talked about Carl Icahn being a guy. Stan Druckenmiller talked about Carl Icahn as taking big concentrated positions. And if you look at his portfolio, he still has 20 stocks. So I think they'll hone in on 1 or 2 things and let him get pretty big. But I think there aren't many people that I know of who trade Livermore style, where it's like, 10 to 1 and you're in 1 or 2 stocks.
It all in. Yeah.
Yeah. It's rare. But it is something I think about, because I think when you study the guys who get the results that, I think most traders are probably looking at it and they're reading the Market Wizard books and saying, oh man, I want to turn $5,000 into 22 million and then do whatever I want in the sunset. The guys who did that, they either took big concentrated positions. They weren't like in 40 stocks, or they were very leveraged on systems. So it's something you probably, depending again on your goals, you need to consider.
Yeah, and the approach of very leverage on systems, I think, is also a simpler way to do it, because you can go, across, let's say, 20 different things, and you could go for 1% losers across the board, and maybe you hit this one that's, out of the park. Which, most of the time what you see is, if you run the systems correctly and you don't have like crazy tight stops or anything, is that you'll have like couple, let's say if you have 20 trades, you have 5 losers, 5 break evens, 5 small winners, and then 2 or 3 huge winners, and then 2 or 3 that might be mediocre winners. And that's very usual for that type of strategy. And also, when you're looking at those big trades, and I think part of the thing that I've been really looking at more and more over time, because I do have specific trades that I do. And if I look at my personal portfolio, these trades actually are very profitable, but I haven't been posting about them much. I just started posting about them on my Substack very recently. And this is basically my systematic approach to find unsystematic trades. Meaning I kind of go around and figure out, if you're looking at every country and you're looking at all these things like a good trend follower would do, you also find that there's these weird anomalies in price action that kind of happen in weird areas. Let's say Turkey, last year I think it was, and basically you start to find these very interesting trades in different areas. And so I do understand the idea of, hey, this is something that I might be very interested in. I'm gonna go big into this. But I also see that a lot of the guys, like, for example, people think like the new trader will think like George Soros took all of his money and put it into one thing. And most of the time that's not true. Most of the time you'll see like when they're talking about a big concentrated bet, I mean, you're talking about 10% of the portfolio, sometimes 20% of the portfolio would be like the biggest bet these guys would even make. So when you're thinking about it as a normal person, you have to also think about it like, hey, these guys are running billions. I'm not running billions. Like it's a different thing. So it's kind of interesting in many aspects of it.
Yeah, I guess like there's a lot of ways to peel the onion. Personally, like I have a hard time with leverage systems. Maybe a little bit of leverage, but a lot of leverage. Like everything I've ever simulated, if you take too much leverage with the system, eventually it wipes out. So if you're, honest with yourself and your data analysis and whatever, that you're playing a game where, like, if you play long enough, you're gonna lose everything. You're just hoping that, you'll kind of get to heaven before the devil knows you're dead, type of thing, right?
Mhm.
And I guess the other difficulty with systems with a bunch of leverage for me is it's just you have to keep firing if you're true to the system. I guess you could build in timeouts and things like that, but usually that's not how systems work. They keep going come what may. And Richard Dennis had a quote where he was talking about, and he's probably the most successful systematic trader from a personal standpoint, without raising money in history, maybe. But he said, when you're getting beat to death, get your head out of the mixer, the paint shaker, and take a break. And that's very unsystematic, right? So I think he would kind of trade the systems with discretion. Maybe that's not what he told the turtles to do, but I'm pretty sure that's what he did based on the stuff he said. So I think it's tough to do a highly leveraged thing with the system. I have heard of a lot of guys who will run systems, but not a lot, but some people that run systems with sort of a percentage of their capital. And then they'll be watching and they'll be doing fundamental research and they'll say, hey, the system is telling me to sell every bond, US fixed income instrument. Technically bonds are 30 years, right? But notes and bills and bonds, whatever. And at the same time, the Fed's starting to raise rates and like it's a good trade setup. And so they'll just say the system runs a percentage and they're going to load up when the stars align in terms of a trade setup and fundamental basis to what they're doing. And obviously that has good and bad results too, depending on the time. And sometimes it works real well and sometimes it doesn't, like everything. So, but yeah, I guess I don't know that many people. Most of the systematic guys that I know, eventually they're in favor of not taking too much risk and not using too much leverage. It's more about survival because that's the secret to long-term success, right? It's not knock the ball out of the park again and again and again. Eventually you're going to wipe out. How's that different from, I guess, the The discretionary guys, I mean, I guess I would say the discretionary guys, again, they start with a small position. They'll add to it if it works, but usually they're watching it very closely. And if it starts to go against them or something goes wrong, back to the Soros and like constantly evaluate and reevaluate, he'll just get out. There was an interview with Colm O'Shea in the hedge fund market wizards, and he talked about Soros was in the press talking up some currency position, and then it moved against him a little bit, and he was just gone. And so the way he traded and his sort of public persona were different animals. And I guess that's an interesting fact to me too. The system guy has to keep going in theory. The discretionary guy could put on a massive position, and if it starts to move, just be like, this isn't working, and just get out immediately. And I think that does lead to some of the more successful traders in history. You know, the faster they get out of things that didn't work, the better. Livermore apparently had a rule. It's like one long run on sentence here, but he would say, yeah, it's the sitting that made me the money. And I thought it was interesting because most people say, oh, you got to sit with your positions. But according to Richard Smitten, who was his sort of multi-book biographer, that wasn't what he meant. And Smitten got to talk to his son and then his other son's ex-wife or widow. And what he meant was, you know, you've got to wait for the stars to align and then put on a position. And one of the things that Livermore said is if you're not making money within 5 or 6 days, something's wrong. You were wrong, get out. So I think that's a key differentiation between the big leverage system guys and the discretionary guys. Is the discretionary guys are constantly watching and they're saying, this isn't working, get out. Now, all that said, at first, you realize that the discretionary guys have the best track records, but maybe not over the span of their career. So point being, like we talk about so-and-so guy and how he made this percentage return for this amount of years. And then it's like, well, what happened after? I'm reading Black Edge right now, which is a book about SAC and all that stuff. And SAC's returns were 30% for years and years. And now 0.72's returns from what I see, I don't get the actual returns, but I think they're more like 9 or 10. So if we look at Steve Cohen from a specific era versus over the entire span of his career, it'd be interesting to see what his true CAGR was. So maybe over the very long haul, you want to do systems instead, but over the short term, the discretionary guys tend to perform best in their good windows. And I personally think if you're going to do the leverage, or let's say this, if I'm going to do the leverage trading, I want to do it discretionarily because I think you have to take breaks. It's just too hard to follow the system with a leverage level that you know you're going to wipe out. And if you try to live too close to the line, usually you'll wipe out or you'll lose faith. So that's a long one, but.
No, I like that because, man, it's the truth, and it just depends. Once again, it's your goals. Like, are your goals to be rich in 2 years? Maybe you got to take some discretionary bets. Is your goals to be consistent over a 20-year period of time? You'll make a lot more money like that usually. A lot of people don't. It's a lot of luck when you just want to put on a major trade. And it's timing, and it's something you and I have talked about a million times, which is it's Fed liquidity. It's all of these things that come into play that really make you those major returns. And I think so many people, they get so stuck in like, I had somebody write me the other day. I had, I had 2 triple-digit years in 2020, 2021, 2022. We were hit 20, almost 30% at one point. And then we ended 2023 up, I think it was 70%. So we've had some great years to me, but somebody wrote me the other day and they said, what do you think happened to your trading after, 2021? And I said, nothing. Why? I said, I feel like I even traded better in 2022. And that was probably my worst return in the last 5 years or so. And they said, well, you had these really great years and now you're just not. And to me, that's it's a thing that people don't understand about trading is it's the environment. The environment in 2020, 2021, everything's trending, everything's moving. You could put on any trade we wanted to, basically, it made money. But if you get into these later stages and you have to be very tactical, your trades your signals aren't galore. Basically in 2020, 2021, we were long commodities basically across the board. I've never been long commodities across the board. There's usually longs, there's usually shorts. more shorts than longs in the last few years. And then 2020 happens, and next thing you know, you're long almost every single commodity across the board. So it's kind of it's an interesting thing to understand. Those major returns sometimes aren't just about, are you the smartest guy in the room? Are you the smartest? Are you willing to take risk at the right time? I was about to say, are you smart? But that doesn't have anything to do with brains, really. It just has to do with it's the Druckenmiller just said recently. He hires a bunch of 20-year-olds these days because they're not jaded from the markets, and that's something that you should also understand, is that at a certain point, do you have the balls to take those positions at the right time? And most people don't, and when they do, they usually have the balls to take those positions at the wrong time.
Yeah, so that's what happened to him, right? His boss at Pittsburgh National Bank or whatever put him in charge because he said, you're too dumb not to charge. Like, it's the same reason they send 18-year-olds to war. They don't, you and I, as I don't know how old you're, 40s, like, I'm old now, but like, I'm going to think about stuff versus just run in. And Rogers talks about that too. He's kind of like, what you want in a bull market is a guy who's just smart enough to be dangerous, but he's making all this money because he doesn't know, and you've got to trade him effectively and get out. I think most people that become legends probably don't want to admit certain realities, like luck played a role in their outcomes. But if you study it and you read enough, you can't definitively say, but I think these amazing track records or at least the windows of amazing track records, are usually a function of like youth, very aggressive because they haven't been hurt yet. Yeah, I mean, you're a bike rider, right? Like a BMXer. Like, probably before you broke whatever, you were way more aggressive. You might have been a little less aggressive after the fact, right? And I think that happens to traders too. So it's like you get this perfect window for a strategy, and you have the right person with the right mentality who hasn't been through the ringer enough to be like, oh, this doesn't make sense. And then they just kill it. And I love the Market Wizard books. I totally recommend them. But one thing I have noticed is they tend to come out at the end of a window, for a very strong window for the people in question. So for example, the original came out, let's say in, I think 82, which was right after just the amazing run of trend followers. And then Stock Market Wizards came out in 2001, right after like one of the biggest runs in the history of stocks with the tech boom, .com boom. And then Hedge Fund Market Wizards came out in 2012. And since then, hedge funds have they certainly aren't what they were before 2012. Let's say that. And so I think that, what does that tell you? It tells you that the guys with the best track records, or at least the subset of their shining window, comes at a specific time, a specific age, a specific risk tolerance, and all these things really play into breakout success. And it's not fun to hear because we all want to believe, oh, we study more, we do more, we can do it. But you get older, your risk tolerance changes, you get bludgeoned a couple times, and you start to say like, if I make that super aggressive bet, it goes wrong, I'm wiped out, and then I can't play the game anymore. So whatever it's worth, I think all those things tie in. I think I mentioned this last week, but one of the other things I've been thinking about is there was this study, and I wrote something about it, but it was basically like the stocks that have done the best over the past 100 years. And it was Altria, Philip Morris, whatever the name has been over the years. It's split into two companies now. But it was the highest returning stock over 100 years with a 265 million % return. But its CAGR was just 16%. And I think that's interesting because we look at things and we say, man, 30%, 40%, 50%. But of things that survived, the best return was a 16% CAGR. And I keep coming back to that and thinking, maybe higher CAGRs than that wipe out. Maybe it's not possible to earn more than that over a long period of time for whatever reason. And yeah, it's hard to kind of prove. But anyway, I guess, I think these amazing returns are specific windows. I think that they're outsized and we all stand in awe and whoa, wow. But if you looked at the entire track record of a career, different windows, it might normalize to something that's not quite as sort of jaw-dropping, unfortunately.
Yeah, man, it is interesting when you think of what you did when you started, and I guess for me, it's a different thing because when I started, I didn't start at a good time in trading. I just got my ass handed to me for years, so like I learned, I learned to manage risk and understand that there's only a few outliers a year, which helped me a lot. But it's the same as you mentioned with sports, like it's not that you still don't have the same drive. It's still the same drive. Hell, I'm 40. I'm definitely a washed up bike rider at this point. But I still have the same drive. My brain still believes I could still do exactly what I did. My body doesn't really think that anymore, but my brain does. So it's the same way with trading for me. And sometimes I think it's why I've stuck so hard with, hey, I'm not going to go over. A lot of guys who are like me, they go under 1% risk. I've never gone under 1% risk. I let these things compound. I think that helps me to stay, produce a little bit better returns, but I know that the drawdowns are there too. I know that the risk is there too. And I'm okay with that at this point. That could change as the time goes on. You never know. It's kind of like when people talk about trading, and they'll talk to me and they'll say, you have really great returns. I'm like, yeah, well, I haven't been trading for 50 years, like somebody like a Jerry Parker, like, even though, its returns have gone down a bit over the years, it's still a very long track record. Like that's longer than most people will ever trade. Same with a lot of these guys. They have ridiculous track records for long periods of time. This is a very hard business. If you can produce positive returns over that period of time, beating the market, you're a really good trader. So it's a tough balance to figure out what you're doing. But once again, like we talk about all the time, if you're a retail trader, you can do it one way. If you're managing funds, you could do it another way. Like there's a million ways to do this. But I do think the idea of some concentrated bets once in a while isn't a bad thing.
No, I mean, I guess it depends how you do it. One thing I was thinking about before today's call is like, is it worth it to know all this stuff about all these great traders? Like, clearly, I've studied a lot of them, and truthfully, I think the most valuable thing that came out of studying them is just the kind of three core consistencies, which is respect the price action of the market. People don't always understand that, but Bruce Kovner says somebody with a lot of money knows more than you do, and they want to make money or protect it, so it's going to show up in the price, right? That's probably the most succinct way to describe that. Then it's stick with your winners and cut your losses, and from there, you can really get, I don't know if confused is the right word, but it can be difficult because there's this natural inclination to try to be doing the best at all times. And as we've said before, I don't think that's realistic. And if you, oh, well, this guy did this and this did this, you can create this Frankenstein monster of trying to merge different styles that don't really work together. And you also get to your point of things not really, there's not one way. That's my paraphrase of what you said. It's like Druckenmiller says diversification is a terrible idea, and then Jerry Parker and the trend followers say it's the greatest thing. Dalio calls it the holy grail. Who's right? I guess everybody's right, or everybody's wrong, or however you want to look at it. But it's like you can really be like, well, should I be diversified or shouldn't I? This guy was successful, and he says yes. This guy says no. So maybe at a high level, the best thing to do is to just take away those kind of three core principles. And then I guess the other two would be manage your emotions and don't overtrade. But then that subject to your goals. If your goal is to make a ton of money, you kind of have to overtrade, and you're going to get clobbered eventually, or if you're smart, you do. So yeah. Anyway, I guess like studying all these guys and diving into their processes and strategies is sort of an interesting hobby to me. But I'm not sure that knowing them all in depth is that beneficial. I think people might be better suited to just sort of decide what's best for them. And they don't, I guess best is subjective. The other thing is, I guess you can't read or simulate. I posted this the other day, but it's like you can't read or simulate your way into knowing how you'll respond to markets and losses and all these things. So you kind of have to try it and experience it to really get a sense of what method is right for you. But from that, you could hone in on one or two people. I guess it's good to know what they do, but then it becomes counterproductive maybe to know too much. So yeah.
I mean, that's a tough one because it's hard because over time you feel like you're learning so much, and it's like it's the Nietzsche quote, that which doesn't kill me makes me stronger. There's also another one which a band used many years ago, which was that which doesn't kill me makes me bitter. And I feel like that's more of a the trader's phrase, because you get hurt sometimes, and that's the thing also about all this. If you are going to take concentrated bets, let's say you just started trading, you're like, hey, this is a great idea, I'm going to make all the money in the world. um Once again, there's other things about this, which is we don't hear those stories, the stories of the legends that start. Those are the stories we hear about. You don't
Mhm.
hear about the stories of the person who put all in on black and lost everything, or bought, calls on Facebook and lost everything. You just hear about those great stories. So once again, it's a be careful out there either way. However you're doing this, what we're trying to do is illustrate the truth of these traders and how they do this, how they've done this consistently over time. And I think that, like George said, the consistency is really in creating a system strategy, really following that. And the major money is made in these very interesting times. Either it's a lot of liquidity running into the market, or some sort of luck kind of running on your side, because that's the other thing is luck also is a part of it. But you make your own luck in a sense. You can look at the markets, you can understand the flows or the risk on periods, or when you should really be putting on the gas. I always like Trader Vic's methodology for that, which is waiting till you basically grind your way up to a 20%, 30% return on the year, and then you can kind of take some more leverage. Maybe your 1% per position loss turns to 2%. You maybe step up your size a little bit by that point. Those things make sense to me. But all in on a position, or just starting out and being like, I'm going to buy 1 year call options on Facebook, and I know it's going to make me a billionaire. Probably not a good idea.
A couple thoughts as you were talking. Like maybe the best thing to do is to kind of learn it all, then go back to your goals,
Hmm.
and then define your goals, whatever they are. Study the people who achieved your goals. Don't dismiss the role of luck that luck played in them achieving their goals, and then design your process, system, whatever, around that. I guess another thing I was thinking is about success. What's common among all the people that achieved a lot of success? They didn't quit, right? So, and as I'm studying these origins of guys that became very successful, it is sort of selection bias in that I don't have the people that didn't make it, but the people that did, however you define make it, they didn't quit. So I was thinking, do I know anyone who stuck with it and still failed forever? And the answer is no. People
No.
give up, right? So you can't control your luck. You can design your process in line with people that have achieved what you want to achieve historically. And then you can just decide, how long are you willing to persist? What are you willing to endure to keep persisting? And maybe the truth is, inevitably you do make it if you adapt enough, but not too much to be kind of like go from left to right, but you just stick with it. I've been thinking a lot about that. I don't know if anybody out there has a good thought or opinion on it, welcome it. But it does seem like the consistency of the people that quote unquote made it, became very successful market people with, businesses, money, what have you. They didn't give up. So I think there's something to be said for that. Now, that said, I always think about Phil Knight, who founded Nike. And he started Nike. It was called Blue Ribbon. He did 2 years, and then it was not going well. So he went and got a job as a CPA. And he said he was thinking of blowing his brains out because he hated being a CPA. And he did that for 5 years, total of 7 years, until Nike got viable enough for him to come back and take a full-time job. He had other people working there. But that's sort of I think about that. Like, who's willing to persist for 7 years? Who's willing to get a day job that sucks or they don't like to pay the bills while they wait for luck to find them? and not many people, right? I mean, it sounds like in hindsight, it's like, oh yeah, well if if you can guarantee me I'll be worth $50 billion, I'll do that. But nobody can guarantee that. You don't know the future. That said, the guys who persisted got there. So maybe there's something to be said for that. And there's no right answer to any of that either. It's just a question of how much you're willing to endure. So
But I think that is the that is the right answer though at the same time, which is if you stick with it. I remember for me, I was laying in a bathroom one time crying like a fucking child about trading because I had just lost a bunch of money again. I had like just a stupid reaction. My dog passed away and I was like I made a stupid trade like, and it was just once again me doing something really stupid. And this is early on in trading. And like I remember like, kind of like laughing, gathering myself and being like, well, I gotta stick with this. I don't think I can do anything else. And over time, hopefully this works out. And I think that's something like you have to have that belief in yourself, one thing, and then you have to also have the ability to stick with it. I think is staying power is more important than anything and whatever you're doing. You have a business, if you could do it for, think about just social media, for example. Everybody understands social media now, we're all on it. If you made 6 posts a day every single day for the next 15 years, what does your following really look like at that point? It's gonna
what
be
do
a
you
lot.
think? You think it'd be a lot?
Oh yeah, oh yeah, because the algorithm would start to pick it up. People would go, "Hey, George is putting out this great information every day. He posts 6 times a day, so I know in the morning I go get this from George." Like all of those things happen because it's a compound effect, and it's the same thing with any business. Not saying if you own an ice cream shop, which is probably a terrible business. Not saying you're going to do great, but if you're in something that you figure out a way to create value and you do this over and over again over time, like it'll grow. And it's the same way with trading is if you can figure out, I think that's why we talk about risk management so much being so important. Risk,
Survival.
yep, survival so you can make it to those good times. Because I don't think it's just a thing where everybody's really great at trading. I think it's a thing where we all have different strategies and they pick up at certain times. I'm a person when everything's ripping, I'm going to make a lot of money. When everything's chopping around, I'm going to get frustrated. I'm not going to make anything. And so I have to stick around and be able to live through those times. And so I think that's also why we talk about risk management so much. And everybody does. Everybody
One
who's a good trader.
I think you got to go, but one final thing. I've been reading a lot of Jack Bogle's books and biographies and watching interviews lately. He's the Vanguard founder, created the first index fund. So he was kind of a hitter, and then in his 30s he got fired essentially, and he started Vanguard. And it took him, I think it was like 6 or 7 years to get viable via the index fund. And now they manage trillions of dollars, literally, right? I mean, he passed away recently. But I just think it's interesting because this guy was like at the top of one of the mutual funds at the time. He was a, a very, known guy, right about him in the Wall Street Journal. And it still took him years. He thought he was going to raise 150 million out of the gate. He raised 11. And it took him another 6 or 7 years to get to 100. So if a guy who has that reputation, that knowledge, that backing takes that long, yeah, I think there's just, the reality is these businesses of success, starting a trading business, whatever, it takes a lot longer than we collectively think. So anyway, maybe we should cut it there for the week.
Sounds good. All right, guys. Well, please check us out next week on Wednesday. We're probably going to be around 10 a.m. from now on. So Wednesdays 10 a.m. Also Friday we have the macro tourist coming on, Kevin Muir. So Friday at 2:15. All right, guys. Have a good one.